Good morning all, and thank you very much for having me here. It's rather rare for me to give speeches, especially at such a prestigious conference as this. And I must confess, I'm a bit nervous. Not because I'm particularly shy or anything, but I was once advised never to give the first speech on the last day of a conference. I was given this piece of advice by a very accomplished hedge fund manager who is absolutely meticulous in his research. Apparently he was asked to give the first speech on the last day of a conference. So he went and he consulted a speech specialist who told him that there is indeed a statistical pattern to audience attention spans during such speeches as the one which I'm giving to you now. According to this research, after only 1.5 minutes, approximately 15% of the audience, they're no longer listening, they're thinking about their to-do list for tomorrow. And after 2.5 minutes, another 10% of you, after a big night, like last night, you're fast asleep. And after 3.5 minutes, as much as 20% of you are deeply engrossed in elaborate sexual fantasies. Even at this time of day. Now, if you look around the room, those are the ones smiling to themselves. So for those of you who fall into the first category, I hope your time is productive. For those of you in the second category, I hope when you wake up that you feel refreshed. And for those of you in the third category, I'm glad that you're having a good time. And for the rest of you, thank you very much indeed for listening. So what is the best way to create value in an increasingly institutional hedge fund industry? And this is not a new question. In fact, it's a question that already had begun to nag at hedge fund investors and allocators well before the global financial crisis, I guess, of 2008. Indeed, it's a question that was asked by none other than the legendary Michael Steinhardt in an opinion piece that he wrote to the Wall Street Journal back in April of 2006. Steinhardt phrased the question a little differently in the title of his opinion piece, which was, "Do you really need a hedge fund?" Even though Steinhardt wrote his piece more than 9 years ago, a number of the points that he made are still highly relevant today. His first point was the following, and I quote, "Hedge funds, they've become an industry. They have become an asset class marketed by investment companies and financial advisors to the masses." Steinhardt continued, "Today," now that's back in 2006, mind you, "there are too many funds being marketed to too many investors. And as recent history, again back in 2006, shows, the outsized expectations attached to the hedge fund mystique simply cannot be matched by performance across the board." Steinhardt's next point is absolutely critical, especially it captures the essence of what hedge funds were all about historically. And he writes, "When I started out 40 years ago, that's now 49 years ago, a hedge fund, it wasn't an asset class. It was simply a fee structure. As managers, we were hands-on and opportunistic, taking big risks for great reward." Let me repeat that. As managers, we were hands-on and opportunistic, taking big risks for great reward. And that really was the whole point of having an incentive fee. I'll come back to this point of taking big risks for big reward, but it stands out not as a quaint historical oddity, but as a clear contrast to what has become conventional and now institutional view held by many hedge fund investors. Steinhardt himself did recognize that this more institutional perspective on hedge funds, as he concedes in his opinion piece. Make no mistake, hedge funds, they're still a viable structure. They can help lower overall risk. They can diversify portfolios and gain exposure to assets unrelated to other holdings. But he couldn't overcome his skepticism, making the following observation, and I quote, "First, thousands of fund managers manage trillions in assets, but this may have more to do with the incentives to the managers than the incentives to the investors." To paraphrase Steinhardt, there are, quite simply, too many hedge funds, and most of them have not performed well, and yet they still charge high fees. Furthermore, I believe that to a large extent, it is very much because of the institutionalization of the industry that this has happened. The institutions have gone from being 10% of the industry's capital to now approximately 90%. Institutions, by and large, are seeking stable and, dare I say, even low returns. But hedge funds are continuing to charge the same high performance fees. In fact, those fees are actually higher because the returns are lower. Single-digit returns are low, but single-digit returns less 20% are really low. The second observation Steinhardt made was, and I quote again, "Realistically, there are only a limited number of truly superior managers. Yet legions of managers earn extraordinary compensation for what, as the indices reveal, has been rather ordinary performance." Remember, he was making that observation back in 2006, but it still holds true, perhaps even truer today, sadly. Steinhardt sums up his personal perspective pretty bluntly. "This is a different business than the one I knew. As a hedge fund manager, I felt an obligation to investors to consistently and meaningfully outperform. That was the only way I felt justified in collecting extraordinary compensation." I must tell you, when I read this last point from Steinhardt, it certainly resonated in my mind, because he was describing the hedge fund industry as I knew it when I first got involved nearly 3 decades ago. When I read Steinhardt's opinion piece back in 2006, it helped to galvanize an idea that I had already been turning over in my mind for some time. I wanted to address the challenge of how to best add value for our clients. And the idea which came to me was really very simple. If we wanted to get the best performance, why not focus on allocating to only the best managers and let those managers focus on only their best ideas? I know that sounds like a tall order, but it did lead us to launch a fund with that very set of marching orders. And the fund is aptly named the Optima Partners Focus Fund. And before we launched the fund, we tested the idea with the managers that we wanted to include in the program. One of the first managers we spoke to was enthusiastically receptive on the idea. In fact, he was already managing a Best Ideas fund. As he put it, we asked ourselves, what would we do with our money if we could do absolutely anything with it? And the answer was to run a concentrated portfolio of only our best ideas with no traditional diversification or exposure requirements. We also looked to quantitative research to validate the idea. We reviewed select concentrated best ideas funds that were run alongside the main hedge funds of the same managers. And our analysis showed that the returns and the volatility were higher, but that the increase in the returns was greater than that of the volatility. The concentrated portfolios also showed equal, or in fact better, Sharpe ratios. Furthermore, research at Harvard Business School by finance professor Randolph Cohen also indicated that the best ideas of managers outperformed by significant increments. I want you to think about when you ask a manager about their highest conviction ideas, that's when they get the most excited. Think about why investors were so keen to allocate to George Soros when he ran the Quantum Fund. They knew that his concentrated high conviction ideas would result in high returns. Ask Stan Druckenmiller what he learned from Soros and what made his own performance record at GAIM such a huge success. And he'll tell you, bet big. And if you look at the great investors that are as different as Warren Buffett and Carl Icahn, they tend to have very concentrated bets. So how has our fund done? From its inception on January the 1st, 2007, through May of this year, it has generated a cumulative return that is over 4 times that of the HFRI fund-weighted composite. It's not my style at all to crow in public, but I'm proud of those results, and I'm also quite proud that the fund has received a number of accolades, including being named winner of the Invest Hedge Global Equity Star of 2012, as well as the winner in 2013 of the Global Equity Fund with a 5-year record. So, how has our fund achieved these results? First, the fund, it reflects our best ideas about which hedge fund manager to invest with. The fund concentrates by allocating to only 10 selected world-class managers. Our roster includes well-known managers, many of whom are now closed, such as Larry Robbins of Glenview, Chase Coleman of Tiger, Rob Citron of Discovery, and Philippe Lafont of Coatue. And because we've been in the fund of funds business for more than a quarter of a century, we have great relationships with these type of managers, which gives us the luxury of being able to access them for the fund. In addition, we have allocated to other less well-known managers who we regard as the up-and-coming stars of the hedge fund business. Second, each of the managers in the program, they concentrate their portfolio on a handful or perhaps 2 handfuls of their highest conviction investment ideas, both long and short. And most of these managers are running separate accounts for the fund, and in some cases they are running concentrated hedge funds in which we've invested. The managers are mostly focusing on equity ideas, but some may also include macro or other strategies. And what I believe is especially noteworthy is that most of our managers, they're also investors in the fund itself, which is probably the greatest confirmation that the fund is indeed a value-added proposition. They clearly like the concept, and they like the roster of managers that we have chosen for the fund. Most other fund of funds are designed to provide diversification, and that is perfectly fine if your goal is to preserve capital and to grow it steadily over time. But the Focus Fund, it's just not your typical fund of funds. Our aim is to generate growth of capital, not by diversifying, but by concentrating. I think Warren Buffett put it best. He has a way of putting so many things best when he said, diversification may preserve wealth, but it's concentration that builds wealth. Essentially, with the Focus Fund, we have taken the fund of funds concept and we reinvented it with a true edge. And by the way, we've been running fund of funds for over 27 years now, so we're firm believers in the concept, but we're also believers in innovation. And the Focus Fund certainly is innovative. I'm not aware of too many other fund of funds like it. To sum up everything about the fund, it really is, it's a back to the future of hedge fund investing by returning to the roots of what made hedge funds so attractive historically before the institutionalization of the industry. As Steinhardt put it, I felt an obligation to investors to consistently and meaningfully outperform. And that is what hedge fund investing, that's what it used to be all about. And this is certainly the spirit of the Optima Partners Focus Fund, which we regard as a very instructive case study of how it is still possible to create value in an increasingly institutional hedge fund industry. And in fact, that's precisely what we've done. So that concludes my remarks for this morning. But as I look around the room here, there are a number of people smiling to themselves. And I certainly don't want to interrupt their fantasies. I mean, of course, their thoughts. But for those of you focused on what I've had to say, thank you very much for listening. Thank you.